How many of you guys on the call right now are underwriting your own multifamily deals in real estate? Show of hands. And if you don't already, turn your cameras on, unmute yourself, drop it in the chat box. Is anyone actively underwriting multifamily deals right now? Why, I see you jumping on here. Brian, Andrew, great to have you. And how many of you guys are relying on, looks like NES is actively reviewing deals. Awesome to see. And is anyone on the call relying on, let's say, third-party professionals like real estate agents, maybe mortgage brokers, or maybe other active investors to underwrite the deals for them? Anyone doing that at all? Okay, good to see. Good to see. So my name's Zach Cahill, and today we're going to be talking about all about how to underwrite multifamily properties the right way. As many of you guys know, there's many numbers involved in this type of real estate, and we're going to be able to dissect that. But before we do, I just want to say thank you for joining the call. I'm seeing some new faces on it. It's always great to see. So just thanks for your energy, for your participation, and obviously thank you for your time. To get really the most out of this session, I do challenge you guys to be 100% present for the next 45 minutes or so. What are we going to be talking about today? A few different things. So number one, we're going to be reviewing different types of multifamily financing, whether that's just, traditional financing at a credit union, whether that's a CMHC financing, and we'll even take a look at the MLI Select program under CMHC. We're also going to be looking at some real life examples. So this is just, deals that are actively being underwritten by myself and our team. We're going to talk about red flags that you guys should avoid, and really ultimately how to become an investor, investing with logic and not emotion. And at the end of the presentation, I'm going to share with you guys the exact spreadsheet that I use to underwrite the deals that I'm going to be sharing with you. Okay. So it's going to be action packed. As I said, my name's Zach Cahill. I started my investment journey back in 2017. At that time, I had absolutely no properties. I was underwriting deals emotionally. And, fast forward to today, 8 years later, we have a portfolio of over 220 doors spread across Greater Sudbury, Ontario. And I've used this spreadsheet and these underwriting techniques that you're going to see tonight hundreds and hundreds of times. So I'm hoping that you can apply, some things that I've learned into your market and ultimately be able to underwrite these properties better. So I'm going to go ahead and share my screen right now. Just give me a thumbs up, guys. And feel free, if you guys do have your cameras, turn them on. And we can make this like a more engaging session. Patrick, good to see you on the call as well. Looks like Kevin jumped on as well. Michael's on the call. Awesome. So before we get into this, I just wanted to say this series that I'm going through, Scott, nice camera. Great. This is 100% for educational purposes only. There's no, I'm not a lawyer, accountant, financial advisor, or licensed to the Securities Commission. It's really just for educational purposes only. Okay, everyone good with that? We'll just get that housekeeping out of the way. All right. So I talked a little bit about myself. Currently investing in Sudbury, Ontario. We've completed over 250 transactions. We have about $40 million worth of assets under management, and I've been doing this for about 9 years now. Okay. There's been a lot of investor pain points that I've seen over these 8, 9 years of investing. And this summer, I had the time to actually visit Sudbury. I was up at a cottage there and really kind of take a step back and figure out like how can I offer the most value to a community of real estate investors. And what I came up with was I created this model, and I'm sure you guys might have seen the model, on social media. Frank, good to see you. And I called it the internal operating system for investors to ultimately build wealth through multifamily real estate investing. Because the challenge I saw is there were so many aspects of real estate investing, right? Like if you're an active investor looking to do this and set up a business, there's just so many different avenues of real estate. So I came up with this framework that in the center really talks about how to build hands-off generational wealth. That is why I created this program, and that's ultimately the core focus for everything I do. And if you're an active investor, and you're working 40, 60 hours a week, Frank, I know you're active. I would encourage you to even apply this philosophy to your business, how to ultimately structure in a way where you could build wealth for yourself, for your family, and your investors in the most streamlined, hands-off way. So whether you're a passive investor looking to get into deals, whether you're an active, established investor, or whether you do a little bit of both, this is what this session is really for. So with that being said, maybe put some answers in the chat box. Like, how do you guys think you would achieve this goal in the middle, this hands-off generational wealth? Just put things in the chat box as I'm talking here, because when I was going, diving deep, a couple things came to my mind. What it meant for me to achieve the hands-off generational wealth is number one, having like a lifestyle freedom. So being able to do like what you want with who you want, wherever you want, having a plan for long-term intergenerational wealth. So it wasn't enough for me just to build wealth for myself. I wanted to figure out a streamlined way where I could hand it down generations, right? That was the whole goal here. And lastly, it really didn't mean anything if I didn't have high investor confidence. And this has been more prevalent in the last few years with, investors not having a high standard like integrity and ultimately like getting themselves into hot water. So when I look at the hands-off generational wealth in the center of the circle here, I needed to have the lifestyle freedom, the intergenerational wealth, and ultimately have the high investor confidence. And how do we actually achieve that? Okay. What I've came to realize is there was three major drivers to achieve those feelings that we want to feel as investors. Okay. The first driver was the acquisition. Okay. So the acquisition meaning we must buy the property right. Okay. Like it doesn't matter how good we are as investors. If we bought the property in the wrong market, nothing else is gonna make sense. All right. And to really get this lifestyle freedom, we must optimize everything we do for financial freedom. We must know, what is like ultimately the financial goal, how many properties is it going to take, and be working with a financial advisor or mortgage broker to make that happen. And lastly, everything we need to do as investors has to be operating with integrity and excellence. So that covers like, streamlined reporting and communication with the investor. Okay. And we'll take this to one further step. Okay. Because what I realized is under acquisition, it's not just as simple as talking about acquisition. There's different parts of acquisition. For example, could be talking about the market selection. So a webinar we've done in the past was specifically on market selection, how to choose the market that you want to invest in, what things to look for, how to, like where to even find the data to do the research. Okay, so that was one of the first events that we did. The next event we did just a couple weeks ago, we did one specifically on lead generation. So for the active investors in the room, this went over, okay, where to find the leads, how to negotiate the leads, and just ultimately like different strategies that you as investors could use to generate the leads. And for tonight's call, we're going to be covering the third really pillar or driver for the acquisition. And that is all about deal underwriting. And it's honestly one of my favorites. It's probably one of my favorite aspects of real estate. It's fun, it's exciting, and I'm hoping to bring some energy for you guys to show you really how to underwrite multifamily real estate. So with that being said, the future calls, the future events that we're going to be doing will be along this line. So for instance, we'll have, 3 events on optimizing for cash flow. There'll be another 3 on the excellence and the operational sides, the reporting side, and I'll release you those titles kind of as we get throughout the presentation. But just wanted to show you guys the overall framework, okay? So all of these strategies, these pillars, these drivers, whatever you want to call, they're all pointing to the middle so that us as investors can really build that hands-off generational wealth. Okay? So today, as I mentioned, we're going to be talking about the multifamily. And I'm going to go through these slides fairly quickly, just talking about the steps. And then I'm going to go ahead and share my other screen and walk you through these steps actually in action. Okay. And feel free as I'm going through this, especially if you're new to some of these numbers or you know, the verbiage that I'm talking about here, to leave comments, put your hand up, and we can definitely get all the questions answered. And there'll be a time for Q&A at the end as well. Okay. So the core thing, if you're not going to get anything else out of this presentation, is this first box right here. Being conservative assumptions. Okay. Like, I can't really stress this enough. And as you go through my underwriting thing, you'll see that I'm conservative with things like vacancy rate, maintenance costs, cap rates. It's much better to, underestimate and find out your deal's better than overestimate and then find out, you don't have a deal on your hands. Okay. I do have an electronic whiteboard that you should be seeing, because can everyone see my screen on a whiteboard here? Can you give me a thumbs up if you can see my screen? Okay. Frank says you can see my screen. Yeah, so I'm sharing my screen right now. I think it's working here. You guys can see me writing on it. So all about the conservative assumptions. We're then going to do some stress testing on the deal. And ultimately, everything we do right now is backed by data, whether it was data on one of the previous webinars we did about selecting the market, or data with ultimately just running the numbers. Okay. So, really, step one at the very beginning of deal underwriting, we need to verify everything. Okay. All the numbers. So, that would include, the income, like and I'm going to keep things very simple. Okay. So, when we're verifying the income of a property, we're going to ask for, tenant acknowledgments. We're going to make sure we ask for this type of stuff when we're even making our offer, so we can see, what are the current rents of the property. You wouldn't believe how many times we've been going through due diligence and the sellers don't even know what their rents are for their units, right? We want to see those signed tenant acknowledgments to really confirm, what is the income. We're going to do the same thing with the expenses. When we go through our due diligence with the expenses, we want to see everything from utility bills to property tax. There's some tools that you can use for property tax. Even insurance, like we want to get our own insurance quotes and things like that. And we'll cover this more as we get throughout the presentation. But step two, all about normalizing the expenses. Step three, it's all about figuring out what the net operating income. And show of hands, is anyone on the call right now familiar at all with net operating income and purchase price? Okay, great. Seeing some hands up. And this is kind of one of my favorite, because what this is doing is it's, based on the NOI. Sorry, I think my pen's running out of ink here. Based on the net operating income, based on the cap rate, we can determine the price of the property. And I'm going to show you guys that in action. So it's very, like, in terms of multifamily real estate, like evaluating it, this is extremely important. Okay. And again, we'll spend some more time on this. Like I said, I'm going to kind of fly through these slides and then we'll get into the real life example, because that's where it will kind of be a little bit more exciting. Step four is all about determining the loan sizes. So I know Andrew McDonald's on the call now, a mortgage broker, and this is also crucial, because there's something called the debt coverage ratio, which I'm going to be sharing on my spreadsheet. And putting it this way, just going over the next few slides, all of these lenders have different rules and regulations to give you money. Okay. So as a real estate investor, you kind of need to understand what those are. And a big factor that they use is something called the debt coverage ratio, which is essentially your annual mortgage payments divided by your NOI, and they want to see certain percentages there. And again, I'll show you how we calculate all this as we get through it. There's different loan sizing and DCR requirements depending if it's a purchase, depending if it's 5 units or 7 units, or if it's a CMHC, or if it's a conventional. So it's honestly very confusing if you're not very streamlined and organized, and you understand what numbers you should be using. Okay. Then once we're even past the DCR, we have to choose, which avenue of financing we want to go. Okay. So, we have the conventional financing, just regular conventional, there's CMHC, there's even a program called MLI Select, all again with different loan to values, different amortizations. Okay. Let's skip past here. This is a chart. I can send you guys this after showing this. And then, I talked a little bit about this at the beginning when we looked at expenses, but this is all, normalizing, the cap rates, the vacancy rates, maintenance rate, admin buffers, property management, snow and lawn, insurance, all the utilities, like renovation contingencies, holding costs. Like these are all things that you're going to have to be factoring in through your numbers when you're underwriting. Okay. What my goal is when I'm underwriting is this right here. I want to determine what the maximum allowable purchase price is for the property. That's my goal. Okay. So in order to do that as an investor, you need to set some key performance indicators for yourself. Okay. So with myself and Sudbury and my company, one of the most key performance indicators for us is cash on cash return. You can see it here. Okay. That is a measurement between how much money was my initial investment and how much money am I making annually in cash flow. Annual cash flow divided by the initial investment. Okay. So if you're looking to get involved in real estate as the active investor, you better make damn sure that you have kind of your key performance indicators marked so you know which type of properties that you're going to be going after. Okay, so for example, for us, we're usually aiming for about a 6 to 12% cash on cash return. Okay, and knowing that, we can do some reverse engineering and figure out what the maximum allowable purchase price is for that cash on cash return. And the markets are always up and down. Sometimes, there's competitive offers, sometimes they're not. This really comes to light when you have a lot of interest on a property and you need to ultimately come forth with your best possible offer. Okay. We're going to talk about some red flags that kill deals, but before we do, these are some case studies that I have prepared, and I'm curious which ones. I don't know if we'll have time for all three. I'm open to starting on any one of them. If you guys can tell me which one you want to start with. I have a deal. This is a previous deal that we did at Baker Street. This was a sixplex that we did. You just put the name of the street in the chat box and we'll go from there. Cedar Street, this is an upcoming purchase. It's a mix between a rooming house and apartments. And then Leslie, this is another upcoming purchase. It's actually a 7-unit. Okay. Frank, looks like you win. Okay. So we'll spend more time on the sixplex. And then I can probably fly through the other ones after you kind of, understand it at a higher level. Okay. Let me stop my share here. Share my screen once more. Got everything open here. Oh, that's not the right one. Okay. We're about to go through lots of numbers here. Let's go. All right. Everyone wanted Baker. That's a little inconvenient for me because this is the one that I've talked about the most. I've done presentations on this deal a fair amount of times. So it's the one that, yeah. Okay. Now, in a previous webinar, guys, I like on the last couple webinars, before I really get into this, you got to understand two things. Because if you weren't on the first two calls, you're kind of missing a lot of the information. So like number one, we did a webinar on the market. So I've already done a 45-minute session on the Sudbury market and why it's a great place to invest and why specifically we're investing in this the downtown core of Sudbury, just because all the the developments, the appreciation that's happening, etc. Okay, so I've already kind of checked that box on this deal underwriting. We already know it's a great market. We already know it's a great location. Make sense? Okay. The other thing that we checked off is like on the last webinar, we did it on lead generation, and I focused heavily on how to build relationships with specific real estate agents who are selling the type of real estate that you want to be buying. And in that lead generation, probably the most valuable thing that came out of it was defining what your buy box was as an investor. Meaning like it's between 6 units and 12 units. We're looking for this minimum cash on cash. And I'll share with you what the buy box looked like. So I just wanted to kind of pre-frame that because this property already checked all those boxes. It's not like we just found this deal and just started underwriting it. There was a lot of due diligence that came up to this to then get us to this place. Okay. Does that make sense, everyone? And now we're going to do the detailed underwriting. So the first thing that I'm gonna emphasize, the first tab on this spreadsheet is all about the as is numbers. It's all about what does the property look like today? Okay? We're not making assumptions. We're just looking at what does the property look like today? So, first thing to note, the purchase price of this property, the listing price, sorry guys, the listing price was 450,000. Okay? Listed for 450,000. There was 17 or 15, 17 offers on this property. And ultimately, let's just pretend that we don't know what to offer. We're going to throw in 495 and just see if this makes sense. Okay? We're going to start somewhere. We're going to start at 495. Okay. So as is right now, the property is generating a monthly revenue of $2,000 a month. It's 6 units. If I scroll down here to show you, it has a 3-bedroom unit rented at $1,220 and a 2-bedroom unit rented at $807. Both these units are very below market rent. Units 3, 4, 5, and 6 are all vacant. Okay, this is why this property had a ton of interest, because investors wanted to get in those vacant units, turn them over, and then rent them out much higher. Okay. As far as the game plan for us, and is anyone familiar with cash for keys? I'm sure that's a term that's talked about a whole lot as real estate investors. We've done cash for keys, many, many times before. But I will say this, the tenants that we've cash for keys in the past are definitely not tenants we would want to have in our properties for numerous reasons. When we did our due diligence on these clients, because we went there, we went on site, we talked to all the tenants, we did the whole scope of work, all the work that needed to be done. We basically determined that, it was actually the landlord that couldn't keep up with the property. So the tenants were actually really good, and like their units were organized, they were clean, and therefore, this is probably the first time I'm really even saying this on a recording here, but I think as real estate investors, especially active investors, there's too much emphasis on just making money. And that's why this cash for keys thing is kind of very just got out of hand. Because ultimately, guys, we could have paid these tenants to leave 100%, but they would have nowhere to go. Okay. And, our business model, yes, we want to make money. Yes, we want to build a generational wealth, but we also want to do good for the community and not contribute to the housing crisis that's going on across Canada. So we're going to assume both these tenants. There was no plan to do evictions or cash for keys. Okay. So it's very important you kind of, make these decisions early on in your investment journey. So the game plan is unit number 1, we're not going to do any work to it. We're going to leave that at 1220. Okay. Unit number 2, game plan there was actually doing something called a unit swap, which is something we always love to do. So this was an elder lady who lived in this 2-bedroom unit. We actually offered her unit number 4, which was going to be a renovated 1-bedroom unit for slightly more rent. And what that did is it allowed her to go from an older style unit to a brand new renovated unit. And on our side, on the business sense, it allowed her unit to be vacant, which then we could go in, we can renovate, and we can set the market rent. Okay, so I'm budgeting here that we're getting about $1,450 for the 2 bedrooms, and then $1,100 for the 1-bedroom. Plus, we're adding some coin laundry. So overall, we bought the property for about $2,000 a month, and then we're increasing the income to almost $8,000 a month. Okay, everyone with me so far? Some thumbs up as we can kind of continue through here. So as far as the expenses, we'll spend a little bit more time on the next slide on expenses, but these were all verified expenses, okay, to be clear. So with taxes, insurance, all the utilities, we have property maintenance in there, property management. Like I said before, the purchase price of this property was $495,000. We're going to underwrite this as, and I think I do have some photos. Let me show you guys here. So this was, to the left was the photos of the property like before we bought it. I don't know what's happened in that bathtub there. but like the property was rough. Okay. And what you'll find when you're doing like not just any multifamily, but specifically value add multifamily, you're not going to be able to get bank mortgages going in. Okay. So we had to use private money, which was high interest financing. We had borrowed $300,000 from a lender in Sudbury, and we paid them 11%. The second mortgage was about 100 grand, and that was actually the seller. So when we negotiated this deal, we did a vendor take back. Okay. And that was negotiated again at 6%, about $500 a month. So 80% of the deal was financed with the high interest mortgage. The goal is then to do the renovations, increase the rent, and then pay off the mortgage and keep it as an asset. Okay. So in terms of month, like, one of the key things as well is like whenever you're working with private money or doing these value add deals, you got to be conscious of your holding cost. On a monthly basis, this deal is losing over $3,000 a month because there's barely any income coming in. We still have all the expenses, plus we're paying for the high interest financing. So we're losing $3,300 a month. All right. Now, in terms of the funds to buy the deal, we've determined it was 296,000. That was a 20% down payment. That was a renovation buffer as well. That covered the holding cost. We budgeted $21,000 for this holding cost while we did the renovations. And we had a $23,000 budget for acquisition costs, which was the land transfer, title insurance, there was lenders fees, there's corps to open, shareholders agreements. There's a lot of stuff that gets into this. And we've ultimately said, hey, to do this project, we're going to need 296,000. All right. Now, the next slide, the next tab on the spreadsheet is showing you guys what we think the property is worth after the renovations are complete. Okay. So we have the new rent totals in here. We've added in the coin laundry. Expense wise, we have again taxes, insurance, we have all the utilities. And if you don't know what the utilities are, typically for hydro, we use $90 a unit per month and water $75 a unit per month. And then same with gas, $90 a unit per month. That's just been the kind of the standard that we've used if we can't verify the expenses. Dwayne, great to have you on the call. Next, we look at the snow. So like lawn and snow, this was like a smaller parking lot. So the snow budget is fairly light. And then property management, we're running the deals at 6%. Everything you see in purple though, these are our contingency funds. So for instance, the maintenance budget of about $370 a month or 5% of the gross income is just a budget, just in case something breaks. Okay. The admin budget is again another contingency fund. We don't actually pay someone the $74 a month. It's simply contingency fund. And then the vacancy rate, we're running with 5%. Okay. So if you guys were on a couple calls ago, we talked about the vacancy rate in Sudbury, which is about 1%. We're still underwriting with a 5% vacancy rate. And that's because we need to underwrite the deals as our lenders would underwrite the deals. Okay. Because if you're not underwriting it like the lenders, you're going to have one valuation and the lender's going to have another, and there'll be a discrepancy there. And perhaps you won't get the mortgage amount that you thought you would. Okay. So total effective gross income we have at the 89,000 minus the operating expenses is giving us an NOI of 56K. Now, if you've seen me do these types of presentations before, I go into a lot of detail on how to calculate the cap rate. For the sake of time here, I'm not gonna go into that detail. But ultimately, what you need to do to figure out the cap rate in your area is ask a realtor to send you comparable sales. So we're getting a numerous comparable sales that look just like our sixplex. We're taking down in a table of, what all the sold dates were of the property. So making sure that these are properties that have sold, within 6 months of the subject property. We're then looking at the price that they sold and the net operating income. Okay. And the NOIs will be posted on those comparable sold listings. And then we just divide the NOIs by the sold price and it would spit out the cap rate. We do this 6 or 7 times and just take the average cap rate. The average cap rate we found for this property was 6.5%. Most of the properties we're buying is about 6.25 to 6.5% cap rate. So if you're going to start underwriting deals in your market, this is due diligence that you're going to need to do. You're going to need to establish that buy box. You're going to need to start looking at comparable sales of that area of that property and figure out what the cap rate is. Because if you get this wrong, none of your numbers are going to make sense. Okay. It's either going to inflate the value or deflate it or be kind of right on the money. What we're kind of really trying to do here, guys, is project the value, like I said, the lender would and the appraiser would. Okay. So using a 6.5 cap, we determine the value is 860,000. Okay. Now, moving on here, we're going to look at what a mortgage would look like at this point. Okay. And I'm definitely not perfect. We make always making mistakes. Okay, that's how we learn from our mistakes. And even on this deal that I'm about to show you, we made some underwriting mistakes on this deal. Okay, so it's not really about being perfect. It's about like recognizing what your mistakes were and then improving on them for the next deal. And every time I kind of do this, let's say I'm pitching a deal and I show an investor, they're like, "Wow, Zach, like, you really know your numbers. You really have everything dialed in." It's like, yeah, that's what happens after you've done the same thing for 7, 8 years. You start catching yourself in mistakes, you improve them, you catch yourself, you improve them. So by no means is this analysis like perfect, okay? But as we've done deals, we've just improved it over time, right? Makes sense? So the value is 860,000. I'm only going to underwrite on a traditional mortgage, and I'll explain. I'm probably going to go on a financing rant at the end of the call, okay? But so a traditional mortgage, when I show you guys the chart there, you're about 75% loan to value. So the value of 860, we could get a new mortgage of 645,000 as long as it meets the debt coverage requirements. That's put in there by the lender. Okay. The amortization rate, honestly, on every deal we do now is 25 years. This was one of our mistakes. We used 30 years on this deal. It actually should have been 25 years. Okay. At the time, we underwrite this one with a 6.5% interest rate. Now, when we underwrite, I am using a lower interest rate. I'm using about 5.5% because I'm able to get a 1-year mortgage right now conventionally for about 5%. Okay. So again, this deal was done like a little bit of time ago when the rates were a little bit higher. So that's why we were adjusting kind of our underwriting. So it's important that you're talking to these lenders and figuring out, okay, what is the 1-year rate right now? Just because of the amount of properties we have with a specific lender, I know I'm getting mortgages right now about 5% or just over 5%. So any current deals, we're underwriting about 5.5%, about 0.5% more. For this one though, at this time the rates were higher. They were like mid to high fives. So we use 6.5. But ultimately here we get a cash flow of 618 a month. The amount of deals that we've underwrote, guys, and this number is then negative and the deal just doesn't make sense. It's hundreds and hundreds of deals. Like this is hard work. You just want to be able to, this is like the snapshot underwriting of just making sure it's going to cash flow. Because you're going to have to do hundreds of deals like this to find the one that's going to make sense. Okay. So cash flowing about $100 a unit, and that's not including the buffer. So we still have an $800 buffer a month. Okay. I said I was going to point out some mistakes to you guys. This is another one. The debt coverage ratio on all of our deals moving forward, we use 1.2. On this deal, it's the way it is right now, it's actually 1.15. What that means is you're at a risk of actually not getting financing to that extent of the mortgage. So typically, traditional lenders, and again, you want to have this conversation with them before underwriting, they're about 1.2 debt coverage ratio. Okay, debt coverage ratio is taking the total net operating income, 55,927, and dividing it by the annual mortgage payment. So the annual mortgage payments here are the 48,507. So basically 56K divided by 48,000, we're actually getting a 1.15. If I wanted to tweak this, I'd actually have to take like a lower mortgage amount. Look, like if I'm taking 72% instead of the 75, so my mortgage is actually overestimated by about 25K. I see some the things in the chat box. So yeah, spreadsheets will be shared, and Dwayne, yes, will be a recording will be uploaded. I'll share you guys the replay too. Okay, and yeah, I'm gonna share with you guys like a blank spreadsheet that you has like more instructions on how you guys can fill it out. But just hopefully that kind of drove home here, guys, because I wanted to show you real life examples, and these are examples that we've done and we actually made mistakes on, right? Because the DCR actually doesn't meet the requirements. Any deals we did after this one is always at 1.2. Okay. So moving on, again, all of our multifamily strategies, like our specific buy box, is all about the fix, then refinance. Sorry, like renovate, refinance, and then repeat. So that's what my key performance indicator is. What I mean by that is this deal's not done yet. We now got to refinance it. We have the new mortgage of 645,000, which I put up here. We would cover refinance costs of about $13,000. I do break down the refinance cost in this spreadsheet that you guys can have a peek at. So that's how we get to that 13,000, meaning we have like title insurance, legal costs, and a lender's fee as well. We would then pay out the old mortgage of 396, and that would cash out refi us 235,000. So if you remember at the start of the deal, we invested 296 to acquire the property. Okay? On the refi, we're projecting to pull out 235,000, leaving us with about 61K left in the deal. All right? Now, to get really down to the nitty gritty and figuring out, is that a good deal? Does that meet our KPIs? What I'm looking for as an investor, as I said before, is I'm looking for about a target cash on cash return of about 6 to 12%. And that's on the first year. Meaning if your cash flow is 618 a month, which is 7,400 a year, if you divide 7,400 by the money left in the deal of 61 grand, I'm getting 12%. Okay? So it actually checks the box for my key performance indicator, right? My cash on cash return. I get a big check there, meaning the cash flow is sustained. And the reason I've seen many investors use different cash on cash return. Some investors I talk to don't even use cash on cash return. But for me and many other investors that I work with, it's by far the most important because it's actually money in your pocket that happens every single month because you take the rent, you pay your expenses and there's cash left over. I'm definitely not the investor that's speculating and buying in areas that are negative cash flow and hoping for appreciation. We covered that in the market webinar. I'm looking for a market that does offer the appreciation and also offers the cash flow, and that's why we want to buy this deal. Okay? We still do have the buffers, which is basically saying like 11% of the rental income just isn't accounted for in this equation. So we have another $800 a month that would be added to the cash flow if we didn't have a vacancy or maintenance call that month. So this is really kind of the the nuts and bolts of how to underwrite the deal. If this cash on cash return came back 5%, then we would just have to offer a different amount of money. Okay, and I think one of the key things and I know many of you guys are familiar with CMHC financing, which offers like much better terms. There's two kind of programs to CMHC financing, one being just a standard CMHC, the other being MLI Select programs. And what I will say is this, and if you're looking at underwriting deals, this is probably one of the most important things. Only underwrite on the conventional side, okay? Because CMHC financing is not guaranteed and it's a government program and things could change. There was times in the past, like we're talking, 3, 4, 5 years ago, maybe, where CMHC out of the blue just changed their rules. All of a sudden, they just wouldn't pay out private mortgages, or all of a sudden they just wouldn't, if you renovated a property, you'd have to have it stabilized for 2 years. And the last thing you want to do is underwrite your deals more aggressively and use, let's say, CMHC, and then something happens and they don't finance your deal. And that could end you as an investor. And I personally know investors that were passively and actively investing. They changed their rules and their deals were no longer deals because they couldn't refinance out of them. Okay, does that make sense? So, there was another spreadsheet that like for instance, not going too much detail here. Um, CMHC ultimately, guys, for those that you don't know, would just ultimately do like a higher loan to value, a longer amortization, and a lower interest rate. And that's the goal for all of our multifamily properties. I'm not saying don't go to CMHC. What I am saying is when you underwrite, just make sure you're doing it traditionally. Because if we underwrote this exact deal you're seeing here with CMHC, the cash on cash return is going to be through the roof, and almost all the capital will be back in the will be back in your pocket after the refinance. But we don't want to assume that and then have something go, wrong. On the spreadsheets that I am sharing with you guys, I did actually add some other tabs in here to also calculate mortgage paydown and appreciation. What do you guys think? Do you guys think you want me to show you guys one more? Want me to show you one more deal here? Maybe do maybe I'll do this one super quick. Okay, Richard says yes, so that's our vote. We get one vote and we're just doing it. We'll keep you guys here all night. So, and I apologize, this is a more recent deal. This is actually one that's closing next month. So this is like literally hot off the press. Again, I'm not gonna go like over the why we bought it and the area, etc. This was just another good solid deal. 7 units. What I think my favorite thing about this deal, if I could say something, is the units were actually in really, really great shape. So the last deal I showed you, there was like 4 units that all needed like full renovations. This building is like elder population with a couple vacancies. So really minimum work to be done. This is like and because of that, we can take it directly to um, we could take it directly to a conventional lender. We don't have to use private financing. So we have it for 675,000 for 7 units plus a detached garage that we can rent. We're getting financing of about 75% loan to value, 20, see, as I told you, 25-year amortization. The only reason I have 5% here is because we already got the commitment at 5%. I had it at 5.5. We can look at it what it looks like at 5.5, but we already got the commitment at, I think it's like 5 or 4.9. So one thing to note is it is losing money at the very start. Okay, I'm just kind of skipping all over the place here. Just excited. So down here we have the units layout. So we have a 2-bedroom, 2-bedroom. This one is vacant. Okay, and then this one's vacant as well. 1 bedroom, 1 bedroom. So like it has really great and then a bachelor. So it's a really great unit layout. Like 4 2 bedrooms, 2 ones, and a bachelor. Okay, yeah, 7 units and a garage. Oh my. So total revenue as is will be $4,700 a month. However, we're going to do a light turnover to both of these units. And we can get 1,700 and 1,450 accordingly for these units after they're turned over. And like, I guess the biggest thing again, is like when we're underwriting deals, I've seen like I only want to underwrite the for sure things. Okay. Yes, we could have more vacancies here. People could move out, etc. But I only ever want to underwrite the for sure things. And I've also made mistakes on this in the past. Like if tenants are living there, I'm not saying that we can turn over their unit unless there's like a signed agreement saying they're moving out or they've just moved out before closing. Okay. You don't want to make those assumptions. Those are big red flag assumptions. The amount of times I've seen realtors, I don't want to throw realtors under the bus, but just like investors or realtors or whoever underwriting deals, and they have one pro forma that's like, here's the as is numbers, and then another pro forma that's like, here's the market rents, and the value's like insanely different. It's like, yeah, that's great, but those people are never going to move out. So why are you even showing me this? Okay. That's my rant. So we only want to do the ones that are for sure things, but still we're getting a $4,700 lift to almost $8,000 a month, similar to the one that I just showed you. Okay. Initial investment for this deal, we determined it was almost just shy of 300K. And the difference on this one is I even factored in borrowing the initial investment or borrowing about 275,000 or 270,000 at 5% for the first year. I even factor that in as an additional buffer because we were going to be using a line of credit for this purchase for part of the purchase. Okay. So altogether, we came with 290. That was doing the renovation cost with the 20% slush fund, the down payment, the holding costs, financing, sorry guys, financing costs. So again, in legal costs, and there was an acquisition cost, meaning like the land transfer, title insurance, and a project management fee to manage the renovations. That was like kind of our general contractor fee. Some other things to note though is even in the why I was stumbling over words there, even in the financing cost, we actually budgeted like an $8,000 lender's fee and a $5,000 or sorry, $3,000 lender's legals. And because we ended up getting this financing with this specific lender, I think our lender's fee is like 0.25% and our lender's legals is actually zero. So like right away, we're going to be further ahead. So anyway, all in there for 292. We're then going to project the value. So again, we have our new rent totals. We have everything listed here. So again, taxes, insurance, hydro, utilities, always using our buffers for admin, management, maintenance. We have a 3% vacancy rate here. We're also pretty conservative with the cap rate because ultimately we could get a 6.25 for this property, which would put the value at about $1 million. But we'll go with 6.5. We haven't talked about this yet, but on multifamily properties, the appraisers do give you a blended value, right? So they are going to value it based on the NOI and based on the cap rate, which we've determined is 957, but they're also going to value the property based on the price per unit. So this spreadsheet, this is actually the one that you guys will get for attending the call. This actually blends the value between price per unit and the cap rate valuation. So it's giving you a blended rate of about 1.1 million valuation, which is awesome. That's what it's worth. However, that's not necessarily what the banks are going to loan on. The banks are going to loan on basically how much money the property's making. So what I mean by that is 95,007, like 957,000. That's the value that most likely the banks are going to loan on because they like when I and a great example, maybe just the education moment here. If they loan 75% of 1.1 million, I'm going to show you what the DCR is. The DCR is 1.04. Does anyone remember what it needed to be from what I just said that we made a mistake on the last deal? It needs to be 1 point something. 1.2, right? Awesome. So it's all great and dandy. You could put here, yeah, like the loan 75%, but it won't meet the DCR. So rather than kind of, figuring out, okay, is it going to be 70% of that? Oh no, it's still not. It might be, 60%. Oh, now it's 1.3. You'll kind of have to keep going back and forth. I just simply just looked at what's 75% of the cap rate valuation. We're getting a new mortgage of 718. And look at that. It actually meets the DCR perfectly, 1.21. Okay. It's actually, so amortization, 25 years. The interest rate, yeah, it's weird. Yeah, weird how I have a higher rate on this side. Oh my goodness, what am I doing? But the 5.25%, like I said, we were already quoted at 5, but who knows? Maybe the interest rate might go up in that time. So we ran it with 5.25%. We're getting cash flow of 883 monthly. I didn't factor it, like I don't have the buffer below it here, but we can figure that out later. Some other things that might be a little bit different on this deal. If I look at the refinance costs, I used a 2% fee to do the refinance. I also did like the legals that you'll need, but I was very aggressive with the refinance costs. I literally don't think it's going to be a 2% fee. Again, I was just going in here as the worst case scenario. Again, if we stick with the same lender when we're refinancing it, it will probably be like a 0.25% fee, which would be a massive difference from 30 grand. Okay. Probably going to be another 13,000 refi. Anyway, we pay out the old mortgage that was 506. Some other things that I didn't take into account. is we started with a mortgage of 506. After 1 year, that mortgage is going to have pay down. I didn't factor that in either. Just being conservative. We'll cash out refi 192,000, which will go back to repay the 292 investment that we did. So we'll have about 110K left in the deal. Okay. With 110K left in the deal, we'll be making 883 a month. We're getting a 9.5% cash on cash return, which meets our mark checkbox in terms of the cash on cash. There are a couple other, as I told you on this spreadsheet, it's a little bit more broken down in detail. There's actually one other key performance indicator that we look at as investors, and it's the 1 year post refinance for the internal rate of return. That's like the IRR. That is calculating 1 year of cash flow plus 1 year of mortgage pay down, dividing it by the capital left in the deal. Okay. So down below here, we'll see that over 12 months, we'll have $14,000 in principal reduction, principal payments. So if we add the 14,000 to the $10,000, we're actually making 24,000, give or take, of income with $110,000 into the deal. We're getting a 22% cash on cash or internal rate of return. I usually like to see that at least at 20%. Okay, so it's 22%. It hits it. We're also, I mean, this is subjective. This was actually only put in here because sometimes investors I talk to want to see what it looks like. I know, Scott, you're in a Sudbury. Sudbury's averaged about a 7% appreciation every single year for 10 years in a row, like give or take. It's the prices have actually doubled since 2015. Some years have been more than seven, some years have been less than seven, but on average has been about 7%. We ran this with a 2% appreciation rate. Okay. So on 2%, that's another $19,000 in, I guess, hypothetical profit. But if we are adding that in, we're getting to a 40% internal rate of return. Okay. My benchmark, my KPI, like I've been stating, always comes down to cash flow because, at the end of the day, appreciation is not guaranteed and mortgage paydown is great, but you're not going to see that in your bank account, right? So I always want to make sure the cash on cash is there. The other two are just gravy, right? That's how, we really build wealth. Cash on cash is just to make sure this property can support itself, right? So it fit it. Again, on the spreadsheet you guys are getting, you'll clearly see this. It also calculates, okay, over 5 years, this is how much principal reduction we've get. This is how much net cash flow we get. One of the common questions I get is, hey, Zach, that's great. We're making $10,000 a year in cash flow, but it's going to take us like 11 years to get this money back, right? But the reality is it's not because you have these other profit centers, right? 5 years of paying down a principal mortgage, $82,000 in profit over 5 years just from paying down the mortgage. 5 years of cash flow is 55,000. So over 5 years, you definitely have all of the capital back from this deal. All of it. Just off of principal pay down and cash flow, right? Not even including appreciation, right? And the goal for me is obviously never to sell, just keep these as rentals, so on and so forth. I don't think we got enough time to go through the last one there, but one thing I will mention is when I look at this, and CMHC does have their own. So on the giveaway, there's just to share with you guys. On the giveaway, there's another slide, just like the one I showed you, that's specifically for CMHC that uses different different rates for management, different rates for maintenance. They have salaries in there. They have some other costs that aren't in the traditional financing. That's a little bit different. Okay. So when you do input your numbers, you will be able to see that on CMHC. But bottom line, guys, CMHC would go to 85%. If we even increase to 80%, if we increase this to 35-year amortization of 30-year interest rate of about 5, the cash flow, it actually can support a higher loan, first of all, because the debt service ratio is now much higher. But cash flow is $1,300 a month. The money left in the deal is now $60,000. This is going to skyrocket the cash on cash return to 25%. Right? The CMHC is really going to light a fire under your deals in a good way. right? Most of the time when you're getting CMHC, the returns are much, much higher, but we don't want to ever bank on that. So that's why we're always doing it conservatively. Okay. So as we wrap up here as well, feel free to unmute, ask any questions you guys have. I'm just going to go ahead, share the last little bit of the presentation, and then we'll go from there. So when you guys get, I will send an email out yesterday with the replay from this. As I said, we just looked at we looked at Baker. We also looked at the Leslie deal. The Leslie one is the one closing next month. Cedar is actually the one in December. But same idea. Cedar Street is meeting I think it's like an 8% cash on cash. It's a 20% internal rate of return. This is the buy box I was talking about. So this was something that we did on our first webinar in Sudbury about the Sudbury market. And then again, we talked about it on the last webinar on lead generation. So just looking at, okay, what type of price per door? What's the total price of the assets that we want to buy? What's the condition of it? Just getting really, really set on what's our buy box, and then proceeding with, the underwriting. So ultimately, just to kind of recap everything we talked about, step one, all about normalizing income. Step two, normalizing expenses. Step three, figuring out what is the actual cap rate, doing those comparable sales on properties that a realtor has shared with you, understanding the DCR requirements in your step four, speaking with your lender, understanding how they're underwriting it. Even speaking with an appraiser is a really good thing to do, just to see kind of what cap rates they're using for the area. Choosing your financing strategy. So whether it's traditional MLI, the MLI Select program, or just regular CMHC, is also very important. I'll be honest, I've never really been into doing the MLI Select. I think there's something that, us real estate investors kind of always try to focus on, like, I want all my money out of the deal. I want like the highest loan to value as possible. I'm a little bit different. I'm always looking at, like, if you really looked at apples to apples and looked at, the benefits of a conventional mortgage, guys, and a 25-year amortization, if you can get a good interest rate there, even at 75% loan to value, your mortgage paydown is significant. Okay. How much mortgage paydown do you think you get if you're at 95% loan to value and you have a 50-year amortization? Okay. Not much. And I talked to an investor the other day that just did like a new build, 8 units, paid $3.5 million or something ridiculous. And he got it with 5% down on the MLI Select program. And I think something that's not talked about is, like, what's a risk? Like, what's the return on that? Like, how do you compare that return to something that you put down 25% on? Like, the answer is you can't. Like, once you get into these really high interest financing, like MLI Select, in my opinion, what happens if that property goes from 3.5 million to 3 million? Like, you don't have any equity. Does that make sense, guys? So it is very high risk, in my opinion. And it does rely on the market appreciating. Not saying I would never do an MLI Select, because we're actually looking at doing one. Funny enough, not a new build, but you got to just be conscious of that, right? Over leveraging yourself as an investor and not having like the equity. Like, there's just so many variables in play, and everybody's talking about MLI Select like it's a sexy topic, and you can get into real estate with 5% down. But there are ways to do it without over leveraging yourself. Okay, like the ones that I'm just showing you. Okay, so choosing your financing strategy, stress testing the deal, making sure that you have all those percentages, determining what your maximum allowable purchase price is, identifying flags that could kill deals. So the reality is like, why we created these spreadsheets and these key performance indicators is to kind of protect us from ourselves, right? We don't want to get emotional. We just want to look at the numbers and be like logically, is this a buy or is this not? Right? If it doesn't meet the key performance indicators, you're going to have to go back to the negotiation table, or maybe back to the renovation table, or figure out something where you're able to kind of make the numbers work. And if you can't, then it's on to the next property. Okay. And I would just say the best bet is just lowering the price. Okay. Lastly, on here, I put make your conditional offer. I mean, if you've been doing this long enough, like you could probably remove the word conditional, because if you've done all the due diligence at this point and understand the financing and the scope of renovations and everything that needs to be done, the reason we were able to get those three deals I shared with you is by having cash offers with no conditions. But sometimes, like, you have to have conditions in your offer to protect you. So always make sure you have those in until you've kind of reached a level of expertise where you kind of have all the scenarios built out there. So those are the steps. Um, you guys can download this right now, or I can email you it. I think I'm probably going to get the replay out in the next couple days, but that's the scan to download it. The first tab is going to talk about, how to use the spreadsheet. The second one is going to be where you put all your as is information. The third will be the conventional numbers. The fourth will be the CMHC numbers, and it will really spit out all the different scenarios for you, and you can start practicing on deals. And even if you're like a passive investor, I think it's still really good to understand so that, when you're getting presented a deal, you have something to underwrite. You can double check the numbers. If a realtor sends you something, mortgage broker sends you something, you want to have kind of your own core way that you're underwriting the deals. All right. So, hope you guys enjoyed the session on the underwriting. The next one is going to be in a couple, I think we're at 3 weeks from now. We're actually on the 13th of November. So if you were on this call or you got any, invites from me, you'll automatically be registered for this one. Okay. This series that we're doing, it's a 12-part series. I think this was number 4. Next one will be number 5. So you'll automatically be registered. If you do not want to be registered, just send me an email or send me a text or reach out and just say, hey, Zach, take me off the list. Otherwise, you're going to get a message that you're going to get invited to this one on the 13th. We're going to do a 3-week break just because we're starting another driver. So we've already done the market selection, the lead generation, and we've already completed the deal underwriting. The next ones we're going to be doing is 3 under the optimizing for financial freedom. The first one on the 13th of November will specifically be on this as a whole topic. Okay, so we'll probably go for 30 minutes or so just to really dive into what this topic means. And then every 2 weeks for the next 3 weeks, we'll break down the specific drivers of optimizing financial freedom. We'll probably take a break for the new year at that time and come back to the new year with the last piece here. And ultimately, we'll have all 12 parts done in the new year. So any if you guys have any questions, you can drop them in the chat box. Unmute yourself now. But as I said, you guys will be automatically registered for the next event. I'll send you guys the replay of this. I'll send you the download for the multifamily spreadsheet if you didn't get it already. And if you do want to look at some live deals that we have coming up, just let me know. I think we still have a spot or two left for that Cedar Street property that I actually just shared with you there. So just send me a message and happy to kind of get on a call. Thanks for jumping on, Richard, as well. Great to have you. Thanks for jumping on, Scott, Victoria, Brian. I'll see you guys on the next video.